My name is John O'Donnell. Very good. I hope you can see my slides. I've had a real challenge here today. I apologize to everybody. The technical gods were dealing with us a little bit. The title of by the way, I'm the co-host also. Not only do I do co-host Power Trading Radio, I would encourage all of you to go visit powertradingradio.com. We have an archive there of over 100 radio and TV shows that stream live over the web, and they're all archived. I think you'll find them quite interesting as a free educational resource. The title of my talk today is 2011 Market Forecasts, what I would call the update to the perception versus reality presentations I've made at fxstreet.com over the years. If you'll go do a search under my name, you'll see a whole series of webinars I produced for them, and this is an update on that theme. I call it the transition to the new normal era via what I call the Globalization 3.0 deleveraging credit purge cycle. Now, that's a mouthful. What do I mean by that? Well, I basically mean, if you think about your life, if you think about markets, it's always transitioning to what's next. And what's next, what's leading this whole change, is the deleveraging of the developed world. And you see it today in what's going on in Europe. You see it today in what's going on in Asia. You certainly see it on what's going on in America. And it's creating a lot of volatility. Well, volatility creates danger for those that are not prepared for it, but it also creates great opportunity for those that are prepared for it. And we like to think the students and graduates of Online Trading Academy are well prepared for it. So I want to show you what the world looks like, at least from my perspective. J.P. Morgan, Jamie Dimon, just recently gave a presentation at Boulder, Colorado, at the University of Colorado School of Business. And he said the things that are going to happen are not going to be very pretty going forward. And he warned that there's a lot of credit purge going on that, and you and I need to become hyper-risk managers and to participate and to protect our capital in this particular era. He brought to the conversation that there are several recessions going on literally across the world, especially the industrialized world, and that some of these economies are starting to recover as measured by the employment rates, but the unemployment rates are still quite large versus historical perspective. So let's put this in perspective for you. In September of 2008, the OECD unemployment rate was about 6.3%, and today it's still up around 8.2%. Germany's starting to improve a bit, but if you look at France and Italy, Britain, U.S., of course Iceland, Greece, Spain, and Portugal, there's still a lot of challenges out there. And only a handful of industrialized economies have lower unemployment rates than they did in September of 2008. And you can see the charts here for Germany, Italy, Britain, Greece, and of course Portugal and Spain. It's not very pretty. Ireland, of course, is in deep trouble. The Western Europe, lovingly called the pig countries, are still going through serious challenges. Now, what's been the root cause of most of this unemployment has been fundamentally demand destruction, and people are buying less goods and services. Many companies, balance sheets, and individuals are trying to right-size or downsize their business models, and we're seeing a flight to safety trade. that's causing a lot of volatility. This is a very interesting chart. Everybody believes that the stock market in America has recovered. This is an index. This is not the S&P. It's not the Dow, or it's not NASDAQ, but it is the institutional index, going all the way back to 1995. You can see that everything peaked right here. This was the extreme peak in first quarter of 2000. This is the cyclical bear market within it. I happen to believe, looking at the institutional index, and how does the institutional index differ? Well, this is an index of the biggest cap stocks in the world that are owned by institutions. And my job today is to try to give you some clarity as to where are we in this continuing secular bear market. And as you can see from this chart, we've just had a 38.2% Fibonacci retracement in this index, but very clearly, going back to the 2000 peak, we have been in a secular bear market now, and we're in the 11th year of that secular bear market, and it continues to play out. So I think as you're trading foreign currencies, you need to keep in perspective the big picture. And the big picture is, at least here at Online Trading Academy, is that we're still in a global secular bear market for all practical purposes. And I use as my proxy for this the institutional index. Now, most investors don't know what the institutional index is. They don't pay much attention to it. But it's an index I have followed for several decades, and I have found it to be an outstanding indicator of where we are. So I've been asked recently about silver. What's happening with silver? It's obviously garnered a lot of news. This is the price of silver, believe it or not, going all the way back to 1800. Even putting the price of silver in perspective, on a relative basis, you can see we've had quite a spike in the precious metals price. Now, this is the London fix for silver, going all the way back to 1965. And in this index, I want you to, I find it quite interesting because I got into the silver market. I used to, way back here in 1971, when silver was at about $1.50 an ounce, I owned a silver reclamation business. And we used to reclaim precious metals. I was the CEO of a company called Precious Metals Exchange. And we used to reclaim silver from photographic and electronic scrap. Now, I was engaged in that whole movement from roughly $1.50 all the way up to 1980, where we had the Bunker Hunt fiasco, where he attempted to corner the silver market. And we literally drove silver from about $1.50 an ounce to $50 an ounce in January of 1980. I think it's important that you recognize after that blew up, that fiasco blew up, we entered into a 20-year bear market in silver all the way through first quarter of 2000. And silver falls in a secular bear market from roughly $50 an ounce to a little under $4 an ounce in first quarter of 2000. Now, we started Online Trading Academy, my partner and I, in 1997, and we were very strong advocates that you should start building a position in precious metals. Now, we didn't know that we were going to take off on this hyperbolic curve, but we felt that adjusted for inflation on purchasing power parity, silver at under $4 an ounce, or right at, let's say, $4 an ounce, was an extreme value. It had remarkably been oversold, and it was time to start accumulating a position. We're well documented on this. And of course, we were highly bullish, as Sam told you in the previous webinar, on our trading floor, on gold as well. Gold was at about $250 an ounce. And for years, I have done indexes I'm going to share with you, known as the Dow Gold Index. And I still do this every Friday. And I recommend you do this. You take the close of the Dow Jones Industrial Average and divide it by the price of gold. So you take the nominal Dow and divide it by the nominal price of gold, and it creates an index, price ratio. Now, I can also do this with oil. That's my denominator. I could use silver. I could use the CRB Index. There are hundreds of indexes or ratios I could create to look at and put this on a chart over time and look at the ebb and flow and change of valuation. And I think that's a much better indicator than using a nominal currency or using a fiat currency like the euro or the pound sterling or the dollar or the yen. Now, I want to show you something. We teach a principle that Sam has brought to Online Trading Academy very successfully, looking for a prior supply and prior demand. And I want you to note that the prior supply of silver at roughly $80 an ounce, or excuse me, $50 an ounce, goes all the way back to 1980. Take a look at this. If I were to draw a supply zone and connect these two, here we are 30 years later, looking at silver coming into this supply zone, and of course, we know what happened after that. We saw a precipitous sell-off in silver, the supply zone being the $50 nominal price. And here we are today, trading at roughly $34.90. I think it touched maybe $35 today. And my next support zone that we have found for silver is in the demand zone between $28 and $31 an ounce. So we got silver today right here at roughly $35 an ounce. We're looking for silver to come down into this zone, somewhere at demand zone, which is going to be somewhere in the vicinity of $28 to $31 an ounce, and then I would start adding to my long position on silver. So that's what it looks like to us. One of the things we've taken a hard look at, and I would encourage you to take a hard look at this, and we teach this in our futures class as well, is the gold to silver ratio. We've seen the gold to silver ratio, the nominal price of gold divided by the nominal price of silver. In late 2009, we saw it peak out at about an 85 to 1 ratio. Recently, we've seen on this sell-off of silver back down to the $33 level and gold at a little under $1,500, we've seen that ratio drop from 85 to 1 down to 32 to 1. Now, where are we today? Well, if you were to take, let's get your calculator out. If you were to take $1,500 silver, $1,500 gold, and divide it by $35 silver, we're at about a 42.8 to 1 ratio. Now, what's very powerful about this ratio is that you can trade it. There are biblical ratios on the gold-silver ratio that go all the way back to 15 to 1. But let's face it, in biblical times, that was primarily a monetary ratio because gold and silver in biblical times was used as money, as a medium of exchange, and of course, a store of value. And what I've always liked about gold, it's a currency. I've always looked at gold as money, and it's had a monetary history, as has silver, going all the way back to ancient Lydia, which was over 3,000 years ago. And I think we have to give it that respect. And the reason central banks hoard gold is because they can't print it. So I think, one of the things I've always been very much a fan of is that when we got into the upper range of this gold-silver ratio would be to sell my gold and take a like amount of dollars worth of silver and buy it Conversely, when we saw silver fall, the silver ratio fall from 85 to 1 down to 32 to 1, it was obviously oversold, and it was time to sell the silver and buy ounces of gold. So I would encourage you to take a hard look at those ratios. Another ratio I'm keeping my eye on today is the CRB Index on the right. The CRB Index just recently reached the 61% fib retracement level, which has now become supply or resistance, depending on how you want to take a hard look at it. And of course, we're starting to see a global sell-off, and I think part of the global sell-off is part of the Globalization 3.0 challenge, is that we still have a lot of credit purge going on across the world. I'm going to tie this together for you in just a moment, and I think it's time to recognize that these commodities have made a great price run, but it's time to either get short or to lighten up our exposure in this area. Now, in our opinion, what is driving the credit purge new normal era? Well, it's still the legacy and hangover, and I guess you're probably tired of hearing this, but it's still the legacy and hangover in housing. Despite the fact in the United States that we have the lowest interest rates, mortgage interest rates, fixed, mortgage applications are falling. Credit purge is still taking place because we've just got, I think it's now 24% of the homes in America have negative equity. That is, they owe more on the homes than what they're worth. We have this humongous shadow inventory. Fannie and Freddie have and investment banks that used to securitize these mortgages, these subprime mortgages. Number one, the subprime mortgages are not getting underwritten anymore, and the primary reason for that is there is falling attraction and there is insufficient private sector capital right now to buy these mortgages. So banks cannot securitize mortgages, take them off their books, sell them off to third parties that want to handle that risk. And I believe we're still going to stay in this credit purge environment, and housing is going to continue to be very weak. If we're not creating a lot of jobs, as showed to you in the previous slide, it's going to be very, very difficult for us to get a lot of new mortgages put in place. We're also seeing challenges in commercial mortgages that remain very weak. We're also seeing challenges in credit cards, receivables getting securitized, and automobile receivables getting realized. Matter of fact, this particular individual, Mr. Hughes, gave a commentary to the Senate Banking Commission, and it said there's barely a pulse in these markets. That is, credit is the mother's milk of capitalism. And not only do we have the credit crisis going on in Western Europe, but we still have the legacy of the credit crisis going on in America. Chris Whalen, who runs a company by the name of Institutional Risk Analytics, said putting trust back in the American housing finance. He said the money is out there, but the trust is minimal. We can talk all we want about supply and demand and home prices and consumer confidence and foreclosures and mortgage servicing, but housing doesn't recover until trustworthy, investable credit is restored. And ladies and gentlemen, I think it very well could take the rest of this decade to clean up this housing mess and restore trust and confidence. The model I'm using for that is Japan. Japan peaked in 1989, both in their housing and the Nikkei index at over 38,000. We've seen the average. We went through their own credit purge cycle. It's been going on for 20 years. It's still in place, and it just hasn't finished yet. It takes time to recapitalize corporate, bank, and family balance sheets. And so I'm afraid to report it very well may take the rest of this decade to clean up this credit purge environment. What this is causing, of course, is still significant demand. Too many homes. We see that in red, these are the total employment. We see in blue, the National Association of Realtors median sales price on homes, and we're still in bear market territory. As a matter of fact, if we look at the CaseShiller 20 City Composite Index, which peaked in July of 2006 at 206, today we're getting ready to break, well, we just broke 140 on the hard right edge. So I don't see a big recovery in the U.S. economy. I see fits and starts. It's a couple of sectors here and there that have real pricing power for their goods and services. But basically, the developed world is still bumbling along through the credit purge environment. And in fact, this is the new normal. Now, all of us want this to recover quickly, but with all the pump priming and quantitative easing programs out there led by our central banks in the developed world, it's just not recovering at all. As a matter of fact, from our friends at Elliott Wave, we now see that the median home price has broken support, and we're moving on down at a precipitous rate. Now let's think about the Dow Jones and housing. Again, I like to do ratios, valuation ratios, and I think this chart puts a lot in perspective. We've got the Dow today up around 12,400, and so this chart goes back to 1984, and it asks a very intelligent question, which you can do yourself and keep track of it, which is how many shares of the Dow, or units of the Dow, does it take to buy the average U.S. home? Well, I could do the same thing in Great Britain. I could say, how many units of the FTSE does it take to buy the average home in Great Britain? And if you take a look at this, you've seen a precipitous drop in this ratio. And it's when you figure that that equity historically in the average American home, or the average American home historically on the American family balance sheet, has been the largest asset in their estate, you can see that the consumer is not doing too well. Well, let's go a little bit further. How many ounces of gold then does it take to buy the average U.S. home? Well, if we would simply take the average U.S. home and divide it by in nominal terms, and divide it by the nominal price of gold, you can see that the same pattern exists. So, and quite frankly, what a lot of people miss in this whole silver and gold rally is the average person in America and the average institutional investor in America own very little gold and silver. The last study that I saw done by the World Gold Council is that if you take all the assets in the world, that's stocks, bonds, real estate, metals, etc., it's still less than 1% of the total assets in the world is gold. So it's still an under-owned asset class, even at these price levels. Now, the simple thing to do then is do the Dow Gold Ratio. And this is the one I have done literally every Friday, and you can do this, and ask yourself a very intelligent question. And you can do this by your country. How many ounces of gold does it take to buy the FTSE? How many ounces of gold does it take to buy the DAX? How many ounces of gold does it take to buy the S&P? How many ounces of gold does it take to buy the institutional index or the Dow? You can do this country by country and use gold as your denominator and treat it like a currency. And treat it and give it the respect of the currency and money instrument it deserves, in that it is a monetary instrument that no central bank can print. It is not fiat. So you would simply, every Friday, and that's what this chart does, every Friday it takes the close of the Dow in nominal price, and divides it by the price of gold in nominal terms. Then it draws a ratio. And this shows you very clearly in 2000, where gold peaked right up here, first quarter of 2000, it took 44 ounces of gold to buy 1 unit of the Dow. Now, how would we do this today? Well, today, let's assume the Dow's at about 12,400. I would take 12,400, divide it by the price of gold today, which is about 1,500, and that's about an 8.2 to 1 ratio. Look at the hard right edge. So we've seen over an 80% decline in the purchasing power parity of the Dow, which are 30 of the largest industrial stocks in the world. And ladies and gentlemen, if your pension plan is heavily dependent upon equities for the growth of capital, preservation of capital, I would encourage you to have some broader exposure to gold. This is the and I could take the same chart and draw it for the S&P. I could take the same chart and draw it for NASDAQ. It's even more extreme for NASDAQ, or the DAX, or the FTSE, or any other index you want. It looks remarkably similar. I could also ask another question, which I usually ask, although I don't have the chart on it handy today, which is how many barrels of oil does it take to buy the Dow or the S&P? And that's a very interesting study as well. Now, here's a very alarming statistic that most of you have probably never paid any attention to, but at Online Trading Academy, we have for years. And that is what's happening with after-tax corporate, our after-tax corporate taxes as a percent of national income. Now, I want you to note in the bottom here that last year, corporate profits reached 9.4 cents per dollar of national income. Now, that's 47% too high by historical standards. If earnings were to shrink to their historic average, which is a PE of about 15 for the broad stock market, would have to rise to nearly 23. The result would almost surely be a plunge in share prices. Corporate profits have commanded this large share of national income only twice before, once in 1929 and once in 2006. And those years preceded the past century's worst two financial collapses. So this indicator is giving us an early warning. For instance, corporations since 1929 have collected an average of 6.4 cents per dollar of national income as after-tax profits. In 1966, corporate profits swelled to 8.3 cents per dollar of national income. They then fell 19% by the end of the decade, and in 97, they were 8.6 cents per dollar of national income, and by the end of that decade, they were down to 13%. So I think it's time to lighten up on equities. I think this cyclical rally we've had in the secular bear, the cyclical rally started in March of 2009. As measured by the S&P, it's been over 100% move. But if you look again at that institutional index, it isn't anything near that. We still have long-term, since 2000, lower lows and lower highs. And I think this is telling us that we're rolling over. And this, again, is that anemic institutional index. And if you compare that to the Dow and the S&P, the pattern is remarkably different. Now, what's the challenge? Here's the challenge we face. And by the way, since we started late, Maud or Vicki, can somebody tell me how much time we have left? This is the challenge we face, especially in America. We're spending right at about $4 trillion a year by our federal government but we're only bringing in about 2.19 trillion a year through taxation. Now, I'm not an advocate of raising taxes. I'm an advocate of cut spending first, and then let's start raising some taxes. But we have to get the spending side of the ledger under control before. Now, how are we going to bridge that gap? Well, historically, how we bridge that gap is by borrowing money from the world's producers and hoping they will recycle part of their savings back to the American Treasury. This is what the new normal looks like. The new normal, well, you got to do a couple of things. It isn't just Bush's tax cuts. We've got to the real problem is too much spending. Look at the curve on the spending side of this thing. We've got to address both. We have to reconfigure how we tax our producers in this country. You just can't take all the money away from the rich. That's not going to get it done. You've also got to address spending. And I'm going to show you what this looks like, because it's grossly, by the time you see this, I think you're going to agree with me, the condition that we're in is just grossly unsustainable. This is what the CBO estimates, that White House and the White House estimates that our deficits are going to look like going forward. And how are we going to finance these deficits? Well, over half of our federal debt is owned by foreigners. Only half of it is financed internally. So we're really dependent upon confidence of foreign central banks to recycle their savings back to America. Okay? So this is a real challenge. All right. Let's take a look at debt as a percent of GDP, because I don't think there's going to be any painless ways out of this. This goes all the way back to 1915, and it shows you that debt as a percent of GDP has, and I'm looking at total debt now. I'm just not looking at federal debt. I'm looking at total debt as a percent of GDP, both in the private sector and the public sector. Notice from, let's go forward to the next chart. I think it shows it a little better. I get this data from the Federal Reserve. This is the new normal balance sheet of America. Total debt in the system, federal, in the private sector, and the public sector, as a percent of GDP. Now, I'm going to quantify this for you in a moment, but let's assume we have about a 14.2 trillion of GDP in America. I want you to note that the gray bars in the background are periods where we had recessions. And from 1870 through 1920, are actually right in here, debt as a percent of GDP was about 150% of GDP. This was the credit binge of the 1920s that led to the credit purge cycle of the 1930s. Now, I believe we're in a credit purge cycle again. I just don't think it's going to be as severe as the one of the 1930s. This is where we financed World War II. This little bump right here, which looks like a small bump in quite a journey. But look where we went after World War II. Debt as a percent of GDP, total debt as a percent of GDP, went all the way back to where it was in the 1800s, at about 150% of GDP, and ran for multiple decades in that region, in that range. Reagan's elected right here in 1982. And what did Reagan bring to the party that created all of this? Well, Reagan started a lot of deficit spending, but he also brought a lot of confidence. And the confidence in America allowed people, or encouraged people, to borrow and spend, both in the public and private sector. And now today, total debt as a percent of GDP is over 370% of GDP. Now, the only country that's even close to this is not Greece, it's not Spain, it's not Portugal, it's not Italy, it's not Ireland, it's Japan. It's Japan. And you know what's going on in Japan. So let's take a look at this. We've seen a lot of debate about this statutory debt ceiling. Well, John Kennedy had this to say: the great enemy of truth is very often not the lie. Lies, in fact, are deliberate, contrived, and dishonest. But the real enemy of truth is myth. Myths are persistent, persuasive, and unrealistic. And there's a great myth running around out there that just because we're the reserve currency of the world, that we can borrow and spend ad infinitum, and that there's no consequences to this action. Well, I'm sorry, I don't believe that. You can see that the rate of debt growth in federal debt growth alone is today out of control. And we have to get this under control. Now, what's this done to the purchasing power parity of the US dollar? Well, this is what's happened to the purchasing power parity of the US dollar. And if you go all the way back, starting to 1914, the dollar today is worth about 4.5 cents as of April of 2011. And it is an issue of erosion of quality of life. You see, what a lot of people forget about America is that we're a small country. Really, we're only about 5% of the world's population, 300 million strong, but we consume 24% of what the world produces. And what the world produces is produced in other currencies. And when our dollar loses purchasing power parity vis-a-vis a basket of peer currencies, you can see that it's a quality of life issue. Now, my question for you would be, why is it in America all of your assets are in dollar-denominated assets? When you look at a chart like this, you can see that that's not a very wise choice. And I don't know what is going to reverse this trend. So let's talk about $1 trillion. It's estimated that this year, and I'd kind of like to end on this note because it's a rather dramatic note I would like to make, no pun intended, which how big is $1 trillion? Well, let's take a look at this. I want you to create a picture in your mind that you have a stack of $100 bills. And we're going to create a packet of $100 bills, and we want to create a packet in $10,000 increments. So I want you to visualize this. Put your knuckle in front of you of your index finger, and you'll see that it's about between the first and second digit, that's about an inch. And I want you to envision a packet of $100 bills that's a ½ inch thick, and it's stacked on top of one another. That would build about a $10,000 unit. Are you with me? All right. So now we've got these stacks of $100 bills. Now, I could be more dramatic. I could use $5 bills or $1 bills. Let's use $100 bills. So if I had 10 of these packs, that would be $100,000. So I want you to envision you're standing at your office, your home, and you walk outside to your front door, and you see 10 of these packets on your front door, and that's about $100,000. Well, believe it or not, this little pile in front of you now is $1 million. That would be 100 of these $10,000 packets. Now, I don't think any of you would have a problem stuffing this into your grocery bag, because this is a pile about 12 inches wide, 12.5 inches deep, and about 4.3 inches high, right? Is there anybody in our room that would have a problem handling that? I don't think there'd be any problem whatsoever. So let's take a look at $1 million. Well, this is what $1 million would look like in these packets. Okay? This is about what $1 million would look like. Now, this would be a whole pallet of these packages. Now, I think most of you, would probably have a problem putting that in a grocery bag. But you'd probably figure out a way to get it home. Maybe you'd go rent a Toyota pickup truck. I don't know what you'd do, but you'd figure out a way to get that $1 million home, wouldn't you? Now remember, these are $100. These are that same packet we're looking at. Now, ladies and gentlemen, now we're getting somewhere. Now, this is $1 billion. Now, I want you to take a look at that picture. You couldn't put that in your laundry bag. You couldn't probably put that in your Toyota truck very well either. Let's assume this is a 6-foot man. How would you get those pallets home? If I were to give you $1 billion, how would you get it home? Huh? Burn it. Why burn it? Well, you'd probably go get yourself maybe a semi-truck, but you'd figure out a way. I bet you everybody in this room would figure out a way to get that home. But we're only at $1 billion. Remember, I want to get to $1 trillion. Now, what do you think $1 trillion is going to look like? Well, let's take a look now of those same pallets. Get that home. 10 billion. How long do you think it takes for our government to spend 10 billion in deficit? Huh? How long do you think it takes? If we're spending 1.5 trillion a year, how long do you think it takes our government, or your government, to spend 10 billion in deficit and actually rob from a future generation? Ladies and gentlemen, I give you $1 trillion. Wow. Now, this is basically the dimensions of a football field or a soccer pitch or a football pitch. This is $1 trillion. Now, what happened to the gentleman? What happened to our guy? Where is he? Where is our little guy? Huh? Notice that all the pallets are double stacked. And remember, these are $100 bills. Wow. Can anybody see our little guy over here on the hard left edge? Look at our little guy here. Now, ladies and gentlemen, let's take a look at this from a different perspective. Let's assume we're up in a helicopter. We're still at $1 trillion. Where is our man? Well, he's way over here. Can you see him? This little speck, he looks like the rear end of an ant. Now, ladies and gentlemen, this is just $1 trillion. So 100 rows times 100 pallets per row is 10,000 pallets. This is a lot of $100 bills. As a matter of fact, if we were to pay this guy to stack the pallets and we allowed him to take one single bill from the top of each pallet, after you're done, your fee would have been a cool $1 million. Nuff said, March of 2007, our national debt in America was $9.19 trillion. Ladies and gentlemen, that would be 9 of these football fields. 9 of them. But ladies and gentlemen, as of March of 2009, and that's since Obama's been elected, so you can't blame all this on Bush, our national debt as of March of 2009 is $11 trillion. Now, where is that little man now? He's over here. I want you to take a hard look at that. I want you to take a hard look at that. Do you know now why silver's at $33? Do you know now why gold's at $1,500? You want to know now why oil's at $100 a barrel? Take a look. If we were to stack the $1 trillion deficit high, and if we laid the $100 bills side by side, end to end, they would travel around the world. That's where we are. We're now bumping up against $14 trillion of debt. This is where we are. It's totally out of control. The answer is not raise taxes. The answer is cut spending first, substantially, in all levels of government, and that includes defense, that includes Medicare and Social Security, and do some tax raising. Simultaneously, there will be some pain. There's no way out of the shortcut. Nine Channel, George Washington. I sent this to palette example to George. He told me he wanted me to redesign the US dollar. And this is what he came back with and suggested that I redesign the US dollar. We're seeing the same thing in Europe. UK debt as a percent of GDP is over 13%. Spain's over 11%. US is over 11%. Greece is under 10%. We're seeing it across the developed world. It's going to create more volatility in currencies as we go along. The gross federal debt is baked into the cake. We show it growing to 19 trillion from 14 trillion given the path that we're on by 2015. Take a look at the hard right edge. There are no shortcuts. There are no ways to get out of this problem. Now, we've been here before. I want you to note, in the 1940s, federal debt as a percent of GDP was higher than it is today. Much higher than it is today. And we did the tough things after World War II through 1980 to lower debt as a percent of GDP. You can see it on this chart. And we grew our way out of it. There are no shortcuts. It's all baked into the data. Do not believe your politicians. Be careful who you vote for in the next election. We've got to get this under control. There are basically two countries that are in the same boat. Others in Greece, Belgium, Italy are moving in our direction, but it's basically Japan and the U.S. You know, I've enjoyed being with you today. I think this paints a very clear picture on where we are. I hope you'll get engaged with Online Trading Academy. Just go to tradingacademy.com, contact an office near you. Get engaged in our XLT programs with Sam Seiden. He and his team do a terrific job in there. I come in there on occasion and contribute content on a macroeconomic world. But I've enjoyed being with you. Also, we got a radio show. It's called PowerTradingRadio.com. Merlin and I co-host that. Go there, PowerTradingRadio.com. There's over 100 hours of radio and TV content with charts. We do it live at 3 p.m. Pacific time, Monday through Friday. God bless you all. Good luck.